689.91%. Seriously, that is not a typo. That's the actual, real-world 3-year return for one single stock. I mean, just imagine putting your money into something and watching it multiply by nearly 7 times, all while the rest of the market is just kind of chugging along. You have to wonder, how does that even happen? What kind of financial engine produces that kind of explosive growth?
Well, welcome to The Explainer. Today, we're taking what looks like a totally dense, intimidating wall of financial data, and we're going to turn it into a clear, fascinating story. We are looking closely at IonQ. We're going to dissect the anatomy of this hypergrowth stock and figure out exactly what makes it tick.
You know, when a stock rockets up this fast, you inevitably get two extremely loud camps. You've got the die-hard believers on one side and the extreme skeptics on the other. But hey, we aren't here for opinions or loud online debates. We are here for the pure, unadulterated data. We want to know, what do the numbers really say about IonQ? So join me as we unravel this mystery together, completely impartially.
Here's our roadmap for today. First, explosive market performance, then the revenue growth engine, the profitability challenge, their fortress balance sheet, those astronomical valuation multiples, and finally, weighing the metrics.
Okay, let's dive into this. Section 1. Explosive market performance, the hook in the hype.
$16.022 billion. That's IonQ's current market capitalization. To put that massive number into perspective, this single company is valued higher than a lot of established, decades-old household brand names. The sheer scale of investor excitement surrounding this stock is absolutely staggering. The market is clearly pricing in something huge here. But getting to that $16 billion, yeah, it hasn't exactly been a smooth ride. It's been an absolute roller coaster. Back in 2022, the stock suffered a brutal drop, plummeting over 79%. But then, look at this whiplash. 2023 delivered a massive 259% gain, and 2024 followed up with another 237% gain. Investors who held on have experienced some wild, stomach-churning volatility, but those consecutive 200+% years, that's exactly what fueled that massive 3-year return we saw at the very beginning.
Moving right along to Section 2, the revenue growth engine, fueling the rocket.
So this is the actual dollar amount powering that massive $16 billion valuation, $130.016 million. That's their trailing 12 months, or TTM, revenue. Now, on the surface, $130 million in sales for a $16 billion company might seem, well, kind of small, right? But in the world of hypergrowth investing, it's rarely about the absolute size of the revenue today. It is entirely about the speed at which that revenue is growing.
And this brilliantly illustrates that point. The sheer acceleration of this revenue is just staggering. If we look at the compound annual growth rate, going back 5 years, growth was essentially sitting at 0%. But look at the 3-year period. It jumps to 126.73%. And then the trailing 12 months hits an astounding 201.85%. This isn't just growth, folks. It's rapidly accelerating growth. The company is literally tripling year over year. That acceleration is exactly why investors are throwing billions of dollars at the stock.
Which brings us to Section 3, the profitability challenge, the cost of growth.
So the crucial point here is the ultimate contradiction of IonQ. You have that incredible 201.85% revenue growth juxtaposed right against a net profit margin of negative 927.45%. Just let that sink in for a second. For every single dollar this company brings in the door, they're effectively losing over $9 to get it. It's a breathtaking level of unprofitability that sits right alongside their astronomical growth.
Let's translate that negative margin into raw dollars just to really see what's happening. Despite making $130 million in revenue, the company burned through $510.378 million in net income losses over the trailing 12 months. Plus, their free cash flow over that exact same period was negative $299.6 million. This is a massive cash incinerator right now. They're aggressively, almost violently, spending capital to build out their future infrastructure.
That leads us to Section 4, a fortress balance sheet, the safety net.
You're probably wondering, how on earth does a company survive over $500 million in net losses without instantly going bankrupt? Well, the answer lies in their exceptional liquidity metrics. Their debt-to-equity ratio is exactly 0. They have absolutely no debt, none whatsoever, and their current ratio and quick ratio both sit at a massive 15.50, meaning for every single dollar of short-term liabilities they owe, they've got over $15 in liquid assets sitting there to cover it. That is an incredibly strong foundational safety net. It means that despite burning hundreds of millions of dollars a year, they have the war chest required to sustain these losses without needing to immediately beg the banks for high-interest loans.
All right, moving to Section 5, astronomical valuation multiples, pricing the future.
To really contextualize the next number we're going to look at, let's establish a quick baseline with the price-to-sales ratio, or PS ratio. As a quick reminder, a normal, mature company might trade at a PS ratio of 2 or 3. Even high-growth tech companies might trade at 10 or maybe 20. Just keep those benchmarks in the back of your mind.
Okay, ready? IonQ is trading at a PS ratio of 123.23. Conceptually, this means that for every single dollar of sales IonQ makes over an entire year, the market is currently pricing the stock at over $123. You're paying a colossal premium because investors are assuming that today's $13 million in revenue is going to become tens of billions of dollars in the future. The expectations for absolutely flawless execution baked into the stock price are, quite literally, sky high.
Now, what's really interesting about this is that even when we adjust for their massive pile of cash, by using the enterprise value to sales ratio, which accounts for that pristine, debt-free balance sheet we talked about, the multiple remains an astronomical 104.83. And because they aren't profitable, their price-to-earnings, or PE ratio, is negative 19.57. Standard, traditional valuation metrics just kind of break down when you're looking at a company priced this aggressively for future perfection.
Finally, Section 6. Weighing the IonQ metrics. Two coexisting stories.
Ultimately, this data paints two very distinct pictures. On one hand, you have the ultimate bull case, a company with zero debt, a total fortress of a balance sheet, and a jaw-dropping revenue growth rate of nearly 202%. They've got the cash, they've got the momentum, and they are scaling so incredibly fast. But directly countering that is the ultimate bear case, a company burning $500 million a year with negative 927% profit margins, currently priced at an eye-watering 123 times its sales.
Which brings us to the ultimate question. Does the explosive 201% growth justify paying $123 for every $1 of sales today? Or will those massive $500 million losses catch up to them first? The data paints a picture of a company walking a very thin tightrope between revolutionary success and financial gravity. Now it's up to you to weigh these metrics. Thanks so much for joining me on this explainer, and as always, keep questioning the data.